Hello and welcome everyone to the Capital Mind podcast. If you'd like to know more about us, visit capitalmind.in. And if you'd like to invest with us, do visit capitalmindwealth.com.
This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. Clients of Capital Mind may maintain positions in the securities discussed in this podcast.
Hi, everyone, and welcome to episode 26 of the Capital Mind podcast. It's been just about a month since we last spoke with you, and what a month it's been. We've had lockdowns, stock market crashes, stock market corrections, and we've already aged quite a bit in the last 1 month. Towards the end of our last podcast, we were wondering if we'd do the next one in our office or over Zoom. And prophetic words, we're doing this over Zoom this time. With the lockdown extended today. So today's episode is on FIIs, or as internally I like to call them, the folks who apparently crashed our markets last month. Deepak, welcome. And is it true? I mean, the rumors have it that FIIs drove down the Indian stock market in March. And even though domestic retail was buying at that time, they overwhelmed them. Is this really the case? How big are these FIIs? Who are they? Why do we care so much about them?
Firstly, thanks, Ray. I think it's been an interesting episode of sorts. We got about 30% fall in March, and if you look at the data, and we classify this data as domestic institutions versus foreign institutions, and the foreign institutional players, or FIIs as we call them, have sold roughly 60,000 crores in March alone in the equity market, or 56,000 crores more in the debt markets. So roughly 1,16,000 crores has been sold in total in just March alone. So this is a fairly large sum. To give you context, this is the single largest month, if you look at months, calendar months, ever. By a factor of 2 in the equity market. The last biggest time was 28,000 crores in in September or October 2018. And before that, even in the 2008 crisis, the sales of FIIs were only 14,000 crores in the month of October 2008. So this has been a very steep fall with an extremely high amount of selling. Now, are FIIs big? Why do we make a big deal of them? The answer is, well, if you think of the Indian market as a whole, today's market cap of the Indian stock market is roughly 112 lakh crores. That's 112 trillion rupees. 112 lakh crores can be divided into half owned by promoters being either the government for PSUs or people like Mukesh Ambani and his related set of companies for Reliance Industries and so on. They own 50% of the market cap of Indian stocks. And of the remaining listed market cap, half is owned by domestic retail, domestic institutions like mutual funds, insurance companies, and so on, corporates and so on that are domestic, and everything else that is half of the free float. Anything non-promoter being the free float, and half of the free float is owned by foreign institutions. Now this is huge because it's roughly saying 1/4 of our entire market is owned by FIIs. That's roughly 27 lakh crores. It's huge for us because that's 1/4 of our market. But there is about adds up to about $400 billion. This is roughly the amount of money they have in India. It's a very small part of the global financial institutional holding abroad. To give you an idea of how small 400 billion is, BlackRock in the US or worldwide actually is an asset manager. It manages roughly $7 trillion in assets. 400 billion would be like 5.5% of just BlackRock's assets. So all foreign institutions put together own as much as 5% of what BlackRock owns as a single institution worldwide. So literally, we're small for them; they're big for us, and I think that's why we care about them so much. But perhaps they don't care about us so much, but even that we'll debunk because they own 1/4 of our market, half of our non-promoter float. So obviously they like us.
Fair enough. So do you feel that they really were, with those large numbers, responsible for the outflow last month? And just continuing on that question, why do we have separate rules for them? Why do we look at them so closely, measure their transactions day in and day out? What's with our obsession with them?
Yes, I think they were responsible for the cash. To answer the first part of the question, and the reason is because if you look at the quantum of selling 61,000 crores in the month, now this is significant in comparison with the fact that any other player does not bring in or add in so much money in any given month. A good month for a mutual fund would be a 6,000 crore month, or an 8,000 crore month would be great, because the 6,000, 8,000 crores contributed by Indian investors into mutual fund, and therefore mutual funds use that money to buy stocks. That would be a fantastic month. And in that same month, you've seen FIIs sell 60,000 crores. So obviously they've overshadowed any of the domestic investment that has been put in. And although the last month also 8,000 crores were put in by retail investors in India, we've seen a significant addition. And yet, foreign institutions have been selling so much that the market has fallen 30%. And this is not just India. If you look at it worldwide, there has been a global liquidity crisis of a massive sort. One of the biggest problems that we've had is not really the coronavirus, but the fact that bond markets, economically, bond markets, stock markets, and home mortgage markets, and commercial paper markets worldwide were frozen for a big part of March. Given the size of this equation, the coronavirus had not even hit us in terms of impact. And yet these markets which were frozen caused a massive liquidity problem. And worldwide, we saw sales of equities to be able to cover margin calls. One of the biggest sales that happened ever. And therefore, the fall in the US, for instance, a 35% fall within 2 weeks is the fastest even since 1929's big crash. So we haven't seen carnage so fast worldwide ever. And similarly with India as well. This sucking out of money out of equities has happened in such a large way that you've seen about $8 billion move out of India, roughly, I think $8.5 billion more of Indian equities. And that pales still in comparison with the fact that $450 billion of equities has been sold worldwide in this last 1 month. So effectively, we are a small part of the world economy. Roughly, we have about 1 to 2% of world assets. So any mutual fund that is invested across the world will have 1% of its assets in India, 1 to 2%. And if you look at $450 billion of selling worldwide, 1 to 2% of that, roughly 8 billion, is being sold in India as well. So we're not any different from the West. And people haven't specifically sold India versus the US or versus Europe or any of the other countries. It's roughly in line with everything. And one of the reasons for that is because a lot of mutual fund investments and investments in India have come in through indexes. So indexing has been responsible for the fall going out as well. Because when you sell, because you have to meet a margin call, anything must go because you need to sell whatever is required in order to get any money. One of the benefits of investing in indexing is you don't have to actually analyze the underlying companies, you just buy the largest ones. But when you sell, again, you don't analyze the underlying companies, you sell whatever is available to sell, and you sell the HDFC banks, the HDFCs. It doesn't matter whether they're a good bank, good company, bad company. You're selling because it can be sold and the margin can be realized. Therefore, you want to sell and exit these investments just in order to make money. Now, given that, I personally believe that while this was responsible for a large portion of the crash, the fact is that it was a little bit of a blind panic selling because it was sold for margin, it was sold for a liquidity reason. So maybe all of that may not necessarily be permanently gone. We'll come back to that in a moment, but let's see about what we do and why we have separate rules for FIIs. India has, for the largest time, been a little afraid of getting foreign investment. There are two reasons for that. One, they think that they will come and gobble up our Indian companies and will not give Indian investors a chance to participate. So they'll own our companies, if you may. The other reason is that they feel that they'll come in and they'll take out their money at the worst time possible and therefore ruin our economy when they take their money out and bring things into a crisis. Both of these have precedents. So in 1970s, foreign institutions were allowed to invest in India as direct investment. So Coca-Cola was here and a number of other companies. but they were forced by George Fernandez to list locally and give out their equity at par to Indian investors. And they said, no, we won't do that. And therefore, Coke left the country. And a few others continued, like Hindustan Unilever and a bunch of others. They continued. These are called direct investment. They're strategic in nature. So they actually own the companies or operate the companies that they invest in. So those that is called FDI. And this is similar to say Amazon, or even for instance investments in Flipkart by VCs. These are all called foreign direct investment. Okay, but the investments in public markets is called foreign portfolio investment, or what we call FPI or FII. It used to be called foreign institutional investment earlier. Now it's called foreign portfolio investment. Now, these were opened up slowly over periods of time. And after 1992 is when the markets really opened up to foreign portfolio investors, keeping in mind there was this fear that those guys would gobble it up. There was another fear. That other fear was that a lot of Indian companies, now remember, India had 90% plus tax rates in the 70s, very high tax rates in the 80s. So a lot of them chose not to pay taxes by moving their money abroad, legally or illegally, however that may be. A lot of promoters and large families would keep their money abroad. A lot of them would become NRIs so that they didn't have to pay taxes in India. So these investments were now outside India, and those promoters know India best. So when India opened up, they would come back in, but they couldn't come back in legally as saying, "Oh, it was my money that I had kept abroad." They came in as entities owned by people that weren't willing to disclose their identities. But this was foreign institutional investment, FII, that was coming in from abroad, maybe Cayman Islands or Mauritius or something like that. This foreign portfolio investment that was coming, some of us knew. I mean, India knew at the time that some of it was this round tripping concept. You earn money in India, shipped it abroad through Hawala or many other different ways to do things, and then brought it back in as foreign portfolio investment. We've seen a number of cases now where people have identified uh, companies owned by Indian companies that are registered in Cayman and that have routed money back into India in different ways. And there was a fear also that if you promote these companies too much, then the people will be encouraged to not pay taxes, ship money abroad, bring it back as investment, and still participate in the Indian economy. So there was rules that were set up to now say, okay, I need to know who you are. So initially, when they said, I need to know who you are in 1992, people said, we're not going to tell you. And we needed the money badly. So we said, okay, for a few years, don't tell us. So in 2007, there was a set of more rules, stringent rules announced that said within 5 years, if you don't tell us who you really are, which means if you came through an island, an entity registered in Mauritius, I want to know who your investors are, and therefore what their identities is and so on. So these rules were set up for making sure that this was not round tripping. These were not people who were not allowed to invest in India and so on. There were also set of rules that said we want to know who can and cannot take out money from India. So that means we have had currency controls for the longest time. A foreign portfolio investor that puts money in can take money out, whatever profits he makes. Of course, you can't take more than that out. So we needed to know exactly how much he invested, when, and how much he's making. India is special in the sense India taxes investment from abroad as Indian income, which means if you come in and buy a share and you make a 10% profit on it, you pay that 10% profit in India. Now, this is not the same case. Let's say you and I were to invest in the US. If we bought an Amazon stock and we made a 10% profit, that profit would be taxable in India, but not in the US. The US says, listen, you're a portfolio investor, you've made your profit, but you're not a tax resident of the US, so I'm not going to tax you. This is not the same in India. So if you're a non-resident of India and are still investing in Indian companies, you have to pay Indian taxes. This is unique. So a lot of FIs came and said, listen, why are you doing that? Because no other country does this, where I'm taxed in my home country. Why should I be taxed here? And my home country will tax me anyway. So what India did was went and did a bunch of tax treaties saying let's not do double taxation in both countries. But they also did one more thing, which was said we'll make a deal with Mauritius, which is a small country which needed its economy developed. So any investment coming from Mauritius will not have any capital gain in India. Mauritius took this rule and asked all foreign companies to come there. So a lot of the foreign companies would come there, register shell companies, and get investment from the US, from the UK, from everywhere else, and use that as a vehicle to invest in Indian companies. This was done for VC companies. This was also done for companies that were doing FII investments into India, simply because since we didn't apply any taxes on companies coming from Mauritius as FPIs or FIIs, there was no taxes payable. Now, if you came directly from the US to India, any transaction would be taxed. So some US FPIs which come directly today, even today also, are directly taxed on any profits that they make. Whereas somebody who came from Mauritius would not have been taxed. Now, this was stopped in 2019 when rules were changed in order to be able to allow India to tax even companies coming from Mauritius on incremental investments made after 2019 as if they were the same par with Indian retail investors, which means if you make a profit, you pay 10% tax on long-term gains, 15% tax on short-term gains. This has allowed a slightly even playing field, but it now brings back the earlier question of, while every other country does not charge us, why do only India charges us? These rules were set up with all this context in place. So to a certain extent, a lot of the rules have been around currency fears that people will take out money from India and our currency will weaken, and also fear of them not owning too much. Now, there are also rules in India about how much a foreign investor can own in a sector. So there's sector-specific investment limits. This is primarily to ensure that foreigners don't completely own our companies. However, as I said, they already do. They have 25% of the total market in India held by themselves.
Fair enough. Deepak, if we have so many restrictions and hoops that we want foreign investors to jump through before they can invest in India and before they can take money out, why are they so interested in India in the first place?
This is actually, quite a surprise to me as well, because, if you ask me to go through hoops, but then if you think about it, what happens really is that India is a very attractive destination because of its size. So it's got 130 billion people. It's fourth or third or fourth, fifth largest economy in the world in terms of GDP. Growing per capita incomes, perhaps not yet at the level where you can say that it's booming or a developed country, but it definitely is one of the better developing countries in the world. Having said that, it's really small in the world context. Our whole market size, as you can see, is only 112 lakh crores. That's about $1.5 trillion, right? In comparison, the US market cap is probably $15 to $20 trillion in the equity markets alone. And you got a bunch of companies that are valued more, almost as much as India's entire market. So you've got Amazon valued at $1 trillion. India is just 50% more than an Amazon. In effect, India is small, but India is too big to be ignored. So every country has this concept where every person has a concept called I want to asset allocate. I want to have a presence in everything. It may not be a big presence. So that's why India gets only 1 or 2% allocation. So you say that, listen, I got 1% in India. So a $100 billion fund may say, listen, 5% of my assets should be in emerging markets. So that's $5 billion. Okay, within emerging markets, I'm going to put maybe 20% in China, 10% in India, 5% in South Africa, and so on. So 10% of that $5 billion, which is about $500 million, then comes to India in that one fund alone. That's 3,500 crores or 3,200 crores that comes to India because of that one fund's tiny 0.5% allocation to India. Similarly, a lot of such funds exist. If you have, for instance, there's an emerging market ETF. This is now an FPI. But this FPI invests in a lot of countries, not just India. They have a lot of emerging markets. MSCI has made an index called an emerging markets index, of which 8% is allocated to Indian companies, or 25% to Chinese companies. There are a bunch of companies in Korea and a bunch of other emerging markets where a number of companies have been allocated different stakes. Now, 8% of that is India, and that a fund called EEM, which is a BlackRock fund, which an iShares fund, which invests in emerging markets, has $80 billion invested in it. 80 billions, 8% is roughly $6.5 billion. $6.5 billion in Indian rupees is about 45,000 crores. To give you context, if this was an Indian mutual fund, this would be the second largest mutual fund in the country. The top mutual fund is SBI, uh, index ETF, which is about 60 odd thousand crores. The second is Kotak Standard Multi-Cap Fund, which is about 28,000, 25, 26,000 crores. So roughly, this would have become the second largest mutual fund in the country. And this is only an 8% allocation of an emerging market ETF, which is also a small fund compared to most of the other funds in the world. So we are actually getting a very small allocation of a large pool which simply wants to put its foot everywhere. Now, India being a big country, you can't ignore it. So you don't want to be caught on the wrong foot. So even an actively managed fund might be saying, listen, if India goes up 50%, I can't go and tell my investors that I don't have any investments in India. I will simply go there and say, I had some, and India is doing well now. Can we put more back in there? And we are thinking of doing that next quarter. So that's another way for you to hedge your bets that your investors will be unhappy that you don't have any investment in a country that's doing well. And India has not done well. Now, if say how badly not well, we are roughly at the same levels. If you had invested in September 2007 in USD terms in the Sensex, today you would be at exactly the same level, 0% return in 13 years. It's that bad in terms of returns. But ignoring the returns people have invested, and I think one of the reasons is simply because you have to asset allocate to multiple countries and you can't ignore India. There's another more sinister, perhaps, but more interesting reason. As I said, some of the FPIs have actually been Indian promoters whose families are invested abroad, and that money has come back. It could be NRIs, it could be their friends who migrated out of India, and so on. One of the things that happens when such an investment comes back is that comes back to India simply because the promoters know India best. They know the times when it is right to invest, maybe not in their own companies only, but also in other companies, where they can conveniently use that as a vehicle to invest rather than using their own names in India, simply because nobody will ask questions of an FPI, whereas people will wonder why, say promoter X is buying that stock if he had bought it in his own name. And this applies to anybody in India as well. So using that cloak of an FPI is actually useful to a lot of people. And sometimes that is also another reason why FPIs continue to invest in India despite not having great dollar adjusted returns.
All right. But let's revisit. Why do you think FIs took out this much money from India? You mentioned then it was liquidity. And have they done something like this before, or was this really just a once in multi-decade event?
Yes, so this time the liquidity equation across the world was horrible. So they took it out, and despite having perhaps no backing in the fundamentals, there was no reason why, for instance, an HDFC bank should fall 30%, whereas 35%, whereas also at the same time some of the stocks which have no debt at all have also fallen 35%. So it's almost like saying we took everything out, and it makes sense in the context of a crisis where people have simply invested in say an ETF which has invested through an indexing approach, and they're exiting simply because the requirement of money was so strong that you simply need to exit and get whatever you could. If that is the context, then any liquidity crisis worldwide would have caused exits in India that is more blind in nature, and that has happened. Now, if you look at the past, when was the last time we saw an exit from debt at this level? This time we've seen an exit from both stocks and debt. Last time we saw this was in 2013, when August 2013, when we saw 31,000 crores exit from debt in 1 month alone. This last month, which is March 2020, was 56,000 crores in debt, so significantly higher. But 31,000 crores in 2013 was also another significant event. What happened at that time was the taper tantrum, which means that in the US, which the QEs that they had done over, significant QEs that they had done over multiple years, had been used to justify the market's high pricing, because there was always money coming in from the Fed. At one point, the Fed literally said, you know what, we may be considering not printing more money anymore. Not even to say that they were taking money out, but to say that they were not going to print any more money, which was a tapering of the QE. That tapering itself, the fear of a taper itself, caused money to exit from assets worldwide. And that liquidity, semi-liquidity, it was about 2 or 3 months, and then Rajan had to come in and calm water. And the US also said, listen, calm down. We're not going to do this all of a sudden. That took a few months, but that time we did see a massive liquidity exit from India, both in stocks. Stock markets fell about 20-25% or 30% roughly. And um, I remember this time distinctly because this was just before I started Capital Mind professionally as well, in terms of taking it into a full-fledged company. But the fear at that time was palpable in terms of how much more money will they take out and can they take out. It was a significant amount of money. It remains another liquidity crisis before this was 2008. So till 2013, we hadn't seen a massive liquidity crisis. After 2008, and 2008 was when we saw a massive liquidity crisis because of what happened at Lehman Brothers. And that time also, it was not a huge amount of money, about 14,000 crores in the month of October 2008. But that money was a similar percentage. Now, if you look at how much FIIs have invested since 2007, to give you a rough idea, 2007 to 2020, the amount of total investments that they've made in the Indian market is roughly 7 lakh crores, which has grown to 25 lakh odd crores. But since they have taken in and taken out money, I don't think they've made any real money in dollar terms, because they've invested this over a period of time rather than all at once. So if you take a percentage of how much 61,000 crores was as a percentage of that, roughly 8 or 9%. And that, even at that time, we are looking at 14,000 crores, was roughly the same percentage of the total amount of money invested since then till then. So it's not like that time was very low and this time is very high. As a percentage wise, we saw a similar amount of money go out and a similar kind of carnage in the markets. In October 2018, we saw about 28% or something falling in a month, and that whole year was a washout, was more than 50% down. This time we're seeing a 35% cut at a 60,000 crore exit. So it was fairly large figures. It doesn't happen all the time. And each of these times, both the rupee and the dollar equation have been hurt. This time, not so much actually. In 2008, we fell. Our dollar appreciated to 20%, rupee depreciated 20%, and in 2013 we went from 55 to 68, again 20 odd percent. This time it's only gone from 71 to 76, which is less than 10%. So, but the reason right now is that RBI participates more in rescuing the market in comparison with what they used to do at that time. So this has happened before. I don't know if it will continue to happen, but obviously you have to look at this from a perspective of India being more tuned into global liquidity flows as well. It isn't very often that FIIs have just decided to exit only India and not others. That kind of thing hasn't really happened in any meaningful way across the globe, across the time that I have looked at. It's maybe small pockets when FIIs got scared in 2007. When India asked FIIs to say, "Tell me who you really are." That's when they decided to sell the next day so harshly that the stock market saw a down circuit in a very bullish period. Nobody will remember this. It was one day in 2007 when only India crashed. That was because these foreign investors decided, we're not going to tell you who we are and don't introduce these rules all of a sudden. And then, when it was clarified this rule will only apply once after 5 years, is when they calmed down and the market kind of came back up. And of course, it was history. The market saw new highs within a month after that, even after a 10% fall on that day. So I think the India-specific things we've seen very few. We've seen more of global liquidity issues having an impact on the Indian FI exits.
Understood. Now, just given all you've said so far, I'd just like to come back to one of our initial questions. Look, if FIIs are so large and their liquidity moving in and out can make such changes in the Indian markets, are our fears or our apprehensions around FIIs, are those justified? Do you think that they deserve to have these restrictions put on them? Do you think that India should continue to monitor them as closely as we do right now? Will they just come and take over everything?
This is again, I think, it has history in it. So, for instance, the fears of will foreign investors come and take away everything? It will take their money out at the most inopportune times. This has a history in the Asian economic crisis when foreign investors were given a free hand to invest in Thailand, in Malaysia, in Indonesia, and their economies crashed after the economic crisis, because foreign investors shorted their currencies, and George Soros had made this incredible bet that they had over leveraged themselves, and they saw currencies depreciate as much as I think some 100 times or something like that. It was just crazy at that time. But however, India took a very outside view of this, because we weren't actually that open at that time. So we've decided that, okay, we're not going to allow these short term. So even now, FIs are not allowed to invest in short term debt easily. Now it's made a lot easier than it used to be. Earlier it was completely banned. Now it's based on certain sublimits. But for everything, they have to go make applications. Can I apply? If I do this, I also have to do that. So there are also rules about what FIS can invest in and so on. And I don't think this fear is justified, because it's like saying, if I don't allow you to fire people, will you ever hire people? So if I made a rule that said you're not allowed to leave, will you enter in the first place? So if the fact is that free markets have a certain attraction because of the freedom itself, right? So you at some point, the efficiency of markets is such that today, when RBI cuts rates, the markets fall. And even the debt markets. You've seen the debt markets fall. This almost sounds like, sorry, when it cuts rate, the debt markets go up. It's almost the opposite of what is written in theoretical books. That if one country cuts its rates, people should exit from that country and put it into another country offering a relatively higher rate. In fact, more money comes into India usually around after this time. So it's almost the negative of that. And one of the reasons is because our rates are relatively higher in any case. Bringing our rates relatively lower will actually make debt a lot more attractive, because it makes for less potential defaults because of high relative interest rates. But having said all of this, we set up a framework of rules, and one of these are these rules effective in allaying the fears? I think it says a lot of it is about regulators saying at least we did something. It's not necessarily true that this will always be useful for for the FIs or for the economy. But the fear that they will exit anytime, which is the worst possible time to make our currency weak, is unfounded, because even with these rules, they are exiting at inopportune times and making our currency weak anyways. There is no protection against that. But if we allowed them more freedom, every time we've done that, they've actually come in much bigger times and actually provided some protection to our currency. That's why our currency doesn't, today we're a lot more free than we were in 2008 or 2013. And therefore our currency is weakened a lot lesser. RBI was available in both times, but this time we've had a lot more of a supporting economy. So supporting, architecture to the rupee. The second part is whether they own most of our companies. Now, they already own 25%, as I said, of the free float. Apart from this, a lot of companies have promoters who are FIs. Maruti is owned by Suzuki. Sanofi is owned by Sanofi worldwide. Abbott is owned by Abbott Pharmaceuticals or Abbott Labs in the US. You've got Hindustan Unilever, whose promoter is Unilever PLC. These are all companies where the promoter itself is not going to be qualified as FPI or FII, which is for portfolio institutional investor. It's going to be called an FDI, which is foreign direct investment. Therefore, they don't even show up in this 25% number. That means 1/4 of our market is owned by the FPI and FII, and a potential small portion of our stocks itself is owned by through FDI. Now, if you look at FPI or FII alone, they already own a significant number of our largest stocks. So take our largest stocks: HDFC Bank, Kotak Bank, HDFC. These are almost majority owned by FIIs, except maybe Kotak. There is a significant ownership in all of these companies by FIIs, our domestic ownership is relatively smaller. If you look at ICICI Bank or HDFC, you might look at them and say these are actually foreign companies because nearly a very large portion of it, much more than 50%, is owned by foreign institutions. So you've got that as uh, uh, a thing that said, even with all these rules, why is our fear that a Bank of China buys 1% in HDFC and we feel very violated when most of HDFC is already owned by foreign capital? So you really are fearful of what has already happened if you think that foreigners will come and own our stocks. Luckily for us, I mean, you think of Flipkart, you think of it as an Indian company. Although it was not an Indian company in any meaningful sort, most of the shareholding was abroad. And if you look deep down, Flipkart India was actually owned by Flipkart Singapore. Therefore, Flipkart India was definitely not an Indian company. It was almost 100% owned by, I think, the Singapore entity. So a lot of companies we think of as Indian today because they're managed or were promoted by Indians are actually with significant foreign ownership. And this is not a problem because it's just perception has changed. Management is perhaps more important than control. So rules to of fear based on fear will always exist. You can't have a generic rule that says foreigners can own all companies outright, and that foreigners cannot own any company outright. So I think where we are is finding the right fit in those rules. Our rules are more strenuous than the West, but I think the fear that they will own more and wipe us all out, if it's real, then it's already happened.
All right, a bit ominous. But now let's look forward. We're not quite sure which countries will do the best when it comes to dealing with the coronavirus out there. So let's say that India, or rather, let's say developed economies in general, either recover faster or slower than India relatively. What does that mean for FIIs and the Indian stock market, just given how influential they are? Should we secretly be rooting for the West to be doing better or worse?
So, the interesting part of the whole thing is that the current crisis based on the coronavirus numbers seems to be that the West seems to have reached certain layers of peaking, whereas India is a little bit behind, so our peaks haven't yet started. So they might recover earlier than us. They've also seen a significant stimulus, both fiscal and monetary. So if the Fed is printing money, and like I said, the liquidity crisis which happened has resulted in large exit of capital from India along with the Western economy. What's happening over there? To counter this, the Fed decided to print unlimited amounts of money. The Fed today is buying commercial paper. Now, typically, central banks give banks money, and the banks go and do their stuff. Now, the banks are not doing their stuff. So what they're saying is, listen, we'll buy bonds. We'll buy government bonds, we'll buy corporate bonds, we'll buy commercial paper, we'll buy mortgage bonds, we'll buy anything you throw at us because we can print unlimited amounts of money and buy it. This is also not uncommon. The Swiss National Bank, once I think owned about 4% of Apple, they printed money, Swiss francs, converted them to dollars and went and bought Apple stock. So central banks owning absolutely everything is not unheard of. The Japanese central bank owns 70% of the Japanese ETF market. The massive scale of this is that more than $5 trillion has been printed in the last 2 or 3 weeks, or will be printed over the next few weeks as well. So at least 5 trillion plus has been kind of committed. Apart from that, there's more than 2 trillion in US stimulus. There's probably 600 billion euros in German stimulus, and more stimulus coming in countries in Europe and the EU in the next few weeks. So we're talking a very large sum of money. If you look at even $5 trillion as a figure, that's less than what I think it will be. But let's say $5 trillion. $5 trillion, if you say that 1% of that comes to India, that's $50 billion. Like I said, what we saw go out of India is probably $8 billion in equity and about $6 billion in debt. And even if you add this up, it's about $14 billion. $14 billion went out. Now, with all this printing, if 1% of this global stimulus comes to India, it's about 50 billion coming in. That's 4x what went out came in. What's going to happen to a market where your daily trades are 55,000 crores? 60,000 crores of an exit caused a 30% fall. How is that going to react to a sum of $50 billion, which is about 330,000 crores, 330,000 crores coming in? It may happen over the next 6 months to 8 months or a year. But even if that kind of money comes in, that would be a ludicrously high number. And given the fact that there's no equivalent seller, there is no equivalent seller of securities at that level, all it's going to do is take prices up. There's just going to be money that comes in. And remember, when a market goes up, more money to invest, more money is invested. It's just the way the markets are and the way people look at markets is that when markets go up, more money comes in and kind of tries to find track momentum in that market. So this $50 billion alone is going to raise our markets to substantial levels. Now, there's another reason for this also, because when you give stimulus, you give it to when you buy bonds from people who are unable to sell them, they get the money. The Fed prints money and gives them money. They look at that bond and say, okay, now I'm safe. I have sold my bonds. I have got some money. Now, a few weeks later, they're like, okay, what do I do with this money? Oh, I can buy bonds again. But I can't buy bonds anymore because the Fed has made those interest rates zero or close to it. And literally any other asset, commercial paper, so all the safe assets are being bought by the Fed. What happens then to people who say, I have money, I want to invest, and I want some kind of a yield? They go and invest in something that's more risky. That something that's more risky is equity. And that's something that's more risky when it comes to us is going to come partly, very tiny percentages, but still come to India. So that's the monetary part of the stimulus. The fiscal part of the stimulus is you're giving people money because they're out of jobs and they have to sit at home. Now, sitting at home in India, at least we're seeing people are spending substantially lesser amount because there's nothing else to do. Even if you give a stimulus to a lot of people, and a lot of these people are going to be rich, they're not going to only be the poor people who receive stimuluses. And the rich people who take the stimulus are simply going to take this money and invest it and not spend it, because there's not enough for them to spend on, and therefore if more money will come into the stock markets, and part of that money again comes to India. So again, I think a lot of whatever is happening to the money printing, stimulus, all of this is just going to result in asset prices going up, and we will be one part of that. So receiving whatever enmity we have for FIIs, they will become extreme friendship, because they'll come back with more and bigger pockets the next time. However, there's a warning to be given. As much as we saw this, we realized that a foreign equity investor who's put in so much money into Indian markets has caused a 30% fall by taking out a very small part of his money. Roughly, they have taken out only about 2 or 3% of the money they've invested. That's their market cap here. Taking out a small percentage of the money has resulted in a large crash. If they come in with more money, 350,000 crores, that's going to make them an even bigger holder of Indian stocks. And when the next crisis hits, we're going to see an even bigger problem. So at some level, there is not enough of a balance. So either India has to get rich enough fast enough so that we can be a bigger participant in our own markets, or we have to be ready for such large crashes to happen more frequently and more likely in the future.
Right. So we do eye what the Fed and the ECB do, but we have to be a bit wary about that as well. Well, anyway, so thanks a lot for that, Deepak. I'll hand it over back to you, and thanks everyone for listening.
Yes, lovely to be here, Shrey, and lovely to have talked. I hope all of you are safe. Wash your hands, and also remember you can get to us at capitalmind_in on Twitter. I'm Deepak Shenoy at Twitter. We're also available at capitalmind.in, where we write a lot of this stuff down in levels of details and charts. And please subscribe to Premium, where our Slack channel will give you a lot of these inputs in real time when we have talks and discussions and webinars and so on. And also, if you want to invest money with us, we have capitalmindwealth.com, our semi-registered portfolio manager, and we have ways to invest both in India and the US through some of our strategies and goals. So we would love to speak more about that. To take a look. And again, thanks for listening.